We are going to go through chapters 2 and chapters 3 in this textbook in the next 10 minutes. Okay? 10 minutes. Which means we really don't have to do it at all. I debate whether just to say read the chapters if you need to. But I'll go through in 10 minutes just so you get a little bit accurate. What's that? It's up to you. In my estimation, you all have studied accounting in your life. You should know chapter 2 and chapter 3 better than I'm going to teach you here. You may have forgotten it, so in which case go back to it, refresh yourselves. So I'm just going to very quickly go through them. I debate not even doing that, but I don't want to leave it out. So bear with me as I rush through them. I don't want to repeat too much. I think what I'll do is after chapter 2, I have a little assignment from chapter 1 that's kind of fun. We'll take a break in the next 5 minutes to do that assignment, and then I'll come back and do chapter 3. Okay. Chapter 2 is about the process of valuing assets and liabilities and measuring income for your financial statements. It's part of the process of assessing the quality of financial statements. So it's valuing assets and liabilities, recognizing income, and then accounting for taxes are the three main topics. So when you determine whether the accounting information is of higher quality, you want to make sure that that accounting information is relevant and it's reliable. You want to make sure that the information that's on your balance sheet is the appropriate information. No, that's wrong.
But it's 508.
Yeah.
You didn't change it anymore?
So it's been sorry. So you want to make sure your accounting information is relevant. And of course you want to make sure that it's correct, reliable. That's what are there for. When you value assets and liabilities on the balance sheet, it could be based on historical costs, it could be based on current information, or could be based on expectations of future outcomes. Primarily it's based upon historical costs. The mixed attribute accounting model provides a basis for determining how you should value assets and liabilities. This is the model. It says that you might use the historical method. You might use current value method or some hybrid. There are 3 historical methods that might be used. You might do it based upon an initial present value of the asset. It might be based upon the acquisition cost of the asset. Based upon an adjusted acquisition cost. We'll go through all of those. It can be based upon using current value methods, a fair value, replacement cost, a net realizable value. Let's go through it. First, historical methods. Generally, this is how assets are valued. The amount initially paid to acquire that asset. That's the acquisition cost. And it includes not, let's think about it as land. Buy land. It's the amount initially paid for the land plus amounts needed to make that land ready for its intended use as part of the acquisition cost. But it does not include costs necessary to operate that. So if you bought some land to create a parking lot, it's the amount needed to level the parking lot, but it's not signage and things of that nature that you might need to make that parking lot, lines that you paint on the ground to make that parking lot useful. So an example could be Red Lobster. I don't know why we chose Red Lobster. they buy land that they intend to build a new restaurant on. They would record that land at its acquisition cost. And land is not depreciated. It keeps its value. So there's no depreciation on that cost. Adjusted acquisition cost is the same idea, except over time, the value of that asset is depreciated or decreased by a depreciation amount. These are buildings or other plants and equipment. So, historical method will adjust those assets appropriately over a depreciated life that's appropriate for that asset. The third historical measure, the initial present value of expected future cash flows. An example of that would be a bond that would be held to maturity. The value of that bond is the initial present value of the expected future cash flows if you hold that bond to its maturity. Or a way you could look at something aside from bond. Let's say you sell an item with deferred payments, so you don't collect immediately for that item, you collect it over time. The amount of that sale is not simply the addition, you don't just add up all those deferred payments which are happening sometime in the future. You have to discount them back based upon an implied interest rate that's based upon the customer risk profile. In the case of selling refrigerators for future payments, you would just have a kind of a general customer risk profile for all your customers when you're paying those payments. So that's the initial present value of future cash flows to tell you how much that refrigerator was actually sold for. Questions? Okay, the current value method. You might want to, you bought land, but things have changed. You found out that land was on top of a toxic that you didn't know about, so it's worth less than you paid for it. You would reevaluate the value of that land sometime today. So you'd actually change that value based upon current real estate value rather than cost that you paid originally. Net realizable value. You own stock in other companies. A lot of tech companies do this. They own stock in each other. There's a good liquid market that defines the value. So you evaluate those assets from time to time based upon current market value for those assets. Hilton Hotel owns a hotel. They want to value that asset. The asset of that, the value of that hotel is based upon the future expected cash flows that they can be bringing in, discounted by the appropriate. So there are various methods. Generally, it's based upon cost, but there are times when it's appropriate to base it upon current value as well. Now, in traditional accounting, income recognition now, you value on the income statement and the balance sheet when value is realized. Let's say you produce wine. The wine is just a bunch of grapes that are not worth much until it's matured into good wine, and that wine has value. The value of that wine is recorded. The increase in the value of the grapes is recorded when you're able to sell that wine in the marketplace. and that will be reflected, that increase in value is reflected at that point, and it also affects the balance sheet at that same point in time. That's traditional. There are times when the value will be reflected in the balance sheet, but not in the income statement. Best example for that is marketable securities. So if your marketable securities go down in value, but you've not sold them, that affects your balance sheet. But since you've not sold them, it has no effect on your income statement until that change in value is realized. So there are times when the value on the balance sheet will differ from what's happening on the income statement. Then there are times when neither the let me say this right. So it's on the balance sheet and it's affected on the income statement, even though it's not truly realized. These are impairment costs. The value of an asset goes down, and it's only down. If it goes up, you don't do it this way. But if the asset value goes down, there's no expectation that you'll ever be able to get that value back. You would then take the loss, even though it's not truly realized. You take the loss on the income statement and the balance sheet would be affected. Even though there's no actual cash changing hands there. So that would be a situation where your income statement and your balance sheet change even though there was no realized change. That's an asset impairment. Okay? Now, when you account for income taxes, it doesn't always match up to the accounting that you do on the balance sheet and the income statement. And there are two general categories of reasons for that. There are permanent differences that will never be the same between accounting for taxes and accounting for your income. And then there are temporary differences, timing differences, between what you do on your taxes and what you do on your income statement. The best example of a permanent difference is if you have an investment in a tax-exempt type of structure, let's say a municipal bond. You get money for that municipal bond. That money is never taxed. So you have income coming in, but it's never taxed. So that would be a permanent difference between income tax accounting and accrual accounting, or regular accounting. Temporary differences are when you have expenses that are different on a timing basis between the two, and the most obvious example would be depreciation expenses. You could have different depreciation schedules for the two. Eventually, they should match each other. They should add up to the same thing. It's just a timing difference. That's it for chapter 2. 10 minutes. Okay, what I'd like you all to do now, does every team have at least one textbook? Work on chapter 1, question number 12, and do not go to the internet. It's kind of fun, and we'll compare your answers up here. Chapter 1, question 12. Work with your teams. Why don't you spend 15 minutes? What you're going to do here, you're going to see some financial information for 12 different companies. I think it's 12 different companies. You're going to try to match those companies to the financial information based upon their industry characteristics. Thank you.
COVID, and it won't become flat.
Okay. So right now it's ready again. Yeah.
Yeah. It's okay.
I need to take it to that sound.
They don't have any intangibles.
Come on up here, your team number, and one will put the name of the company in Excel. Whatever it is. Um, 3 minutes.
Can we like collaborate on the app? So for Abercrombie and Fitch, did we all say two? Okay. For Allstate, I have one. That's DuPont. I was 4 or 5. Yeah, I was taught previous too. 5. I wasn't sure what those two. Okay, HSBC 10. Kelly's 3. 8. Why did you have such high intangibles in the Kelly's? McDonald's has such brand recognition. That's intangible. I had the reverse. I don't know if it's right or not, but I feel like Kelly's. Why would they have so many intangibles?
How can you guys get done so fast?
Never heard of Kelly. I don't know. Just like, I mean, I don't know either. That's correct. One is Kelly.
We were just responding to the pressure that you were applying.
All right, we'll get back to that. Burke, I have 9.
Interesting.
Okay, you guys going up?
Yeah.
Don't be the last team.
And then Omni Group, 12. Pacific, 11.
Yeah.
8 and 7. Or Kelly. Operating expenses
You get to PG.
Yeah.
That's okay. Got it. You just need process.
Then we have HP. Then we have
Omni's fine.
Then we have Best Buy. Then we have Groupon.
I don't think that McDonald's has that many.
Yearly different. Then 9 is Merck. 10 we have HSBC as well. Then Pacific Gas and Electric. And then we have Allstate. I think it's
We could put McDonald's as 3, because I feel like they would have more inventory than Kelly's.
we have Pacific Kelly.
Why does a lot of people have Kelly's? A lot of people have Kelly's.
A tall lefty.
What?
In an effort to not ask our teammates the right stuff, we just narrowed it down.
Just take it from here. There's a reason I don't want to give it to you to take away.
Sure, of course. No, not take away. Right here in front of you.
So,
Bring your pads on. I'll take care of this. Bring your pad.
P&G.
What's next?
The number 1 corresponds to this first line, correct?
Yes.
Yeah, you went down.
want to change teams yet? We have a clear winner. You got to choose Merck. Anyone else? Are you all agreed? Yeah. He is still up in this thing. You'll close here. Okay. I'll tell you the number you got right. Team 1. Team 2. Team 3. Line. Team 4. Broke the trend. And one team who promised me they didn't look at the internet. I'll be watching them. So case 6, come on up and explain it. When you win, you lose. That's very good, by the way. Congratulations, guys. I think time out. You don't need to go through all. Just go through the main one. You know, you get one otherwise.
Obviously, for this hierarchy, was
Yes.
Yeah. So we determined they would have a high cost. I mean, like the inventory number is not significant. Other ones,
Mhm.
so that's why we determined.
Right. Did they have a higher margin than Best Buy? I forget. I'm not looking at profit margin. Yeah. Lower than Best Buy. Yeah, because Best Buy sells more. Best Buy sells more of a commodity product. And, okay. Well, good job, guys. That was just to kind of get you looking at financial statements, kind of being able to look at financial statements and get some information out of it. Company basis. Okay. We will now do chapter 3 in 5 minutes. During the break, I received confirmation that the 14th is good for us, so everyone put on your calendar. But if we find ourselves that we're on task, we won't have it, but we should put on our calendars that, you know, we will have it unless otherwise stated. Just so you don't schedule something, and if you have work or something that day, I'll take attendance, but I'm not going to hold attendance against you if you can't make it. So accrual accounting is on an accrual basis. Cash flows are very important to an analyst because cash is what determines whether you stay in business or not. Whether you could earn all kinds of money, but if it's all in receivables that you are in the future and you don't have cash to pay your debt, then you're out of business. So cash is king. So Chapter 3 focuses on cash flow. And, really, the statement of cash flows is the kind of the stepchild of the financial statements. We always look at balance sheets and income statements, and the statement of cash flow comes third. But it's equally important for what we're trying to accomplish. So a statement of cash flow looks something like this. Broken down by cash from operations, cash from investing, and cash from financing. And you separate it out because at the end of the day, you really care about cash from operations. If you can't generate positive cash from operations over the long haul, you can't stay in business. You need to generate it from operations. And when we talk about cash, we really talk about cash and cash equivalents. There are some items that are very similar to cash, like short-term treasury bills, commercial paper, and money market funds. We talk about interest paid and dividends paid, and then interest and dividends received are also forms of cash that may or may be in the operating or the financing activities, depending upon what line of business you're in. If it's normal for you to receive interest as part of your business, it should be in operations. Otherwise, it would be in financing. And similarly, interest received and dividends received could be from investing, or if it's a normal part of your business, it could be from operations. As you can imagine, cash flows don't equal income flows. So if you look at your income statement, it will not be identical to your cash flow statement, your statement of cash flows, because of accrual accounting. Because there's a timing difference because of that. And also there are some non-cash, right? What's an example of a non-cash expense? An easy one. Depreciation, the most obvious. So there are two ways that you could report cash flows. The direct method looks like the income statement, except it's on a cash basis rather than an accrual basis, or the method that we'll use and you generally see used, which is the indirect method. You begin with the net income from the income statement, and then you add and subtract to it in the three categories to get to your change in cash. So we'll focus on the direct method since that's the method that is used. Working capital is just a definition. Working capital is your current assets minus your current liabilities. And two types of adjustments that you would make from your income statement to your cash flow statements are non-working capital adjustments and working capital adjustments. So adjustments associated with these current assets and liabilities are your working capital adjustments, and the others are your non-working capital adjustments. Okay, so non-working capital adjustments. Depreciation, we talked about. Deferred taxes, stock option expenses, gains or losses on the disposition of assets, pension costs, impairment charges. So these are non-working capital assets, you know, PP&E, etc. And in each of these cases, your cash flows would be higher than your net income. Impairment charges reduce your net income, have no effect on your cash flow. Depreciation reduces your net income, has no effect on cash flow. So all of these non-working capital adjustments have the effect of reducing your income without reducing your cash flows. Working capital adjustments might increase, might decrease your cash flows versus your income. If your accounts receivable from one period to the next increases, what does that mean? I'm sorry? They owe you more money, so it reduces your cash, right? That's an increase in accounts receivable will have a negative effect on your cash versus your, compared to your income statement. And if it decreases, it would have a positive. So there are a variety of changes in your accounts receivable, changes in your accounts payable, and these other kind of current categories that would also result in a difference between your cash and your income. Now, your changes in cash flow depend upon your life cycle. That didn't work. Now I'm going to go to the next slide. I like this slide. This kind of brings together the ideas of how your revenues grow and shrink over the life cycle of a product or a company, how your net income changes, and how your cash flows change. Let's go through it together. Your revenues. When you introduce a product, or a company has only one product, and in the early stage of that company, you'd expect relatively small revenues during the introduction phase. During the growth phase, dramatic increase in revenues. During maturity, they're leveling out and starting to go down. And then the declining phase of the product, your revenues go down eventually to zero as the product becomes obsolete. So that's the shape of your revenue curve through a product's life cycle. Income, introductory phase tends to be negative. The cost of production is greater than your ability to generate revenues for it. During growth is when you start to have positive growing net income. Maturity, you're milking the product, you're doing well. And then during decline, you're still doing okay. There's a reason you're still in business even though the product is declining. But eventually, it's time to get out of business when you start losing money on it. Now let's look at cash flows. And we've broken the cash flows down into the three components. The cash flows from operations, that's this line, very similar to your net income. That you would expect that you're draining money, cash, from your operations early on. And then as your net income is increasing, you're also delivering cash to the industry, to the company, and then it declines at the end. Financing. Early on in a product or in a company, most of your cash is coming through financing, whether it's through floating bonds or angel investors or venture capitalists or going to the public markets, however you're doing it, you're getting your cash early on, not from your product, but through financing. And over time, you're paying off financing, and you no longer, at some point you have no more financing. You're just paying for financing. Financing becomes a drain on your business. But early on, it delivers cash. Towards the end, when you're not doing any refinancing, it's just draining cash. And investing, you're making investments. You're taking your cash and you're converting your cash into investment income. So here in the maturity phase, when you have excess cash, you're able to use that cash to invest and generate more money for your company. Early on, you don't have the ability to do that. That's why it's negative down there. So this is kind of the life cycle, the phases of the life cycle of cash versus net income versus revenue. Okay? Now back to, this is not life cycle for Pepsi, but this is how Pepsi's cash flows look. Their net income is here. Their cash flows from operations are greater than the net income. Their non-working capital adjustments are there. So these adjustments, non-working capital adjustments, have the effect of what? What do the non-working capital adjustments do to net income? Your net income is lower than your cash, right? So this is really defining this difference right here, more or less. And then it shows their net income from investing. It's whatever. Or their cash flows from investing, and their cash flows from operations, which we talked about up there. And then their working capital adjustments, which are more or less zero, right? They're just, sometimes they're positive, sometimes they're negative, depending on what they are. And they're a mature company, so they're not doing a whole lot of new financing, which is why you're not seeing positive cash flows from financing here, right? They're not doing new financing. They're not floating new bonds. So this is Pepsi. It's typical for a mature company. Now, here's a company. Based upon what we just talked about, what stage of the life cycle do you think this company is in? Yeah, I mean. You think they're in growth? Let's give it another second or two. What's your question? Did you have a question? Maturity, okay. I'm not sure about, well, I don't want to say anything. Intro? Okay, so there are 4 phases. How many say introductory phase? Good. Growth? A few. Maturity? So everyone else is saying decline? Decline. No clue. Honesty is good. Well, the first thing you see is they have a negative net income, right? that'd be tough on a company that's in maturity, I would think. That would be a bad sign for a good, mature company that's just trying to milk their product. They're showing some positive cash flow from operations, generally speaking. You're right to ask whether it's year 4 or year 3, and it's not always positive. But generally speaking, it was positive over the average of the 3 years. So it may not be introductory because of that. Cash flow from financing. Is positive. And cash flow from investing is generally negative. So let's go back to the previous slide. Okay, so what did we say? Income was generally positive, so it's somewhere in here. Cash flow from operations, what did we say? Oh, net income was negative?
Yes.
Oh, so it's here?
Yeah.
Okay. Cash flow from operations was? Oh, this is crazy. It's here? Financing is positive, so it's here. No, the financing was positive, and investing was negative. So we know it's somewhere in here. In fact, it was Overstock.com from a few years ago, and they were at the time kind of here, the beginning of growth phase. Now, I don't even know, do they still exist? Yeah? Anybody ever buy anything for them? Oh, is that right there? Just Amazon resale. Okay, so again, you get information out of your financials. Right. Okay, chapter 3. So again, if chapters 2 and 3 went too fast for you, please feel free to read the chapters. We will go forward now to chapter 4, which we will not finish today. Profitability analysis. So we're going to jump from assessing the quality into profitability analysis. We'll go back to assessing quality. It's important. There's just some things we need to understand from here before we go back. So we're not done with assessing the quality of financial statements by any stretch. We'll talk about return on assets and return on common equity, earnings per share, and some ratio analyses. So profitability analysis. You want to be able to, from time to time, evaluate the effectiveness in executing a strategy. And for what we're doing, and that's management accounting stuff, what we're doing is the second one, which is by understanding past performance, it'll help us to forecast the future. And so to do this, we're going to focus on the financial statements. The ROA, the return on assets, tells you the profitability of operations relative to the assets that you hold in order to produce those operations, and is independent of the cost of financing. ROCE and earnings per share tell you the ability to generate a return on capital. What's your ability to provide a return to your shareholders? And these numbers are relevant really when you look at them over time. There's no correct return on assets. There's no correct ROCE. You really want to look at them over time, or you want to look at them compared to the industry or compared to competitors. Of course, comparing to competitors is difficult. Even the closest of competitors, Pepsi and Coke, are really in different businesses. You know, Pepsi owns, is it Quaker Foods? I think it is. They own Frito-Lay's. So when you're comparing Coke and Pepsi, they have different businesses. And they're the closest competitors you could find. So let's first look at return on assets. You may have seen this at other times with a slightly different formula. Starts with your net income. You add in your interest expenses, factoring in taxes. You also add back in any minority interest you have in the earnings of any other companies. So Pepsi's minority interest in the bottlers would be considered in here. And then you'd divide that by your average total assets. So again, whenever you take information from both an income statement, things like net income, and information from your balance sheet, like your total assets, you take your beginning total assets plus your ending total assets, add them together and divide by 2 to get your average total assets. And you're only including income from continuing operations when you do this. And one of the challenges you'll all have as analysts for your companies is figuring out which earnings are relevant looking forward and which ones are not. Again, it does not want to consider financing, which is why you're adding back any interest expenses that you might have paid out after tax. That's what this is all about, adding back in interest expenses you paid out from your net income. So the interest expense reduces net income, but we don't want to think about it, so we're adding it back in. So again, you're adding back in minority interests. Okay, so that is your return on assets. And the return on assets could be broken down or disaggregated into profit margin and asset turnover. Profit margin is your ability to generate earnings from sales, right? So you would take your net income, the numerator from that previous equation, and divide it by your total sales, total revenues. Asset turnover is your ability to generate sales from your assets. And so if you multiply profit margin by asset turnover, sales would come out and it would be adjusted net income over average total assets, which takes you back to ROA. So this disaggregates ROA into 2 useful components, profit margin and asset turnover. And we'll talk about why they're useful in a moment. So looking at Pepsi, their ROA is a very robust 15% or so, with a 14% or so profit margin and an asset turnover of 1.1. These would be considered pretty good numbers. And you can see that year over year, they've done something to improve their profit margin. Their asset turnover hasn't changed. They've improved their results year over year by improving their profit margin. You can break down profit margin by really looking at it on a percent basis, understanding the components of profit margin. And you can break down asset turnover by looking at your components of your assets to figure out which one is doing, how you're doing for your various components, accounts receivable, inventory, and fixed asset turnover. Let's look at that. Okay, let's look at asset turnover first. You have accounts receivable turnover. It's the net sales that you had on account and the average accounts receivable. And it tells you how quickly you're able to convert accounts receivable to cash. How long does it take you? And you can flip this and figure out how many days you have in accounts receivable. Inventory, you take your cost of goods sold, and then your average inventories, beginning and ending divided by 2. And this tells you how long it takes to convert product into sales. And then your fixed asset turnover, sales over average fixed assets. And it shows you how high your level of sales compared to your investment in PP&E. So if we look at Pepsi again, it's this side of the equation. Their asset turnover, the highest level, we see their ROA. It was improving year over year. Their asset turnover, for the most part, didn't change. But you look at the components of asset turnover, and you see it's changed slightly, but not much. They've just stayed pretty stable. If you look at your profit margin, you can compare year over year, which you saw some improvement on. You can compare year over year on a percentage basis and see where your improvement in profit margin was coming from. And where do you think it's coming from here? What do you see? Interest revenue, yeah. That's part of it, a little bit of it. Slight uptick from the bottlers. Cost of goods stayed about stable. That costs a little bit in administrative. And that's what did it. I didn't hear the last part of it. Uh-huh. No, they really attribute to the total asset turnover. Right? They don't attribute to that. So now if you look at industries, return on assets should not be expected to be the same across industries. The ROA across different industries should be different. For one, certain industries have greater risk associated with them. And you'd expect that as an investor, you'd expect that if there's greater risk, there should be a risk premium those assets should be able to take more money back. Otherwise, why would you be in that business with the greater risk? Operating leverage. Operating leverage is the idea of replacing variable costs with fixed costs. The garment industry, which I guess you're going to care a little bit about, apparel industry. They don't do that. How do they do their business? They go overseas, Bangladesh, unfortunately, and get very cheap labor overseas, and they have high, that most of their cost of production is a variable cost of labor because they can get cheap labor, rather than building, big plants in the U.S. that will be fixed cost based. So operating leverage is increasing your fixed costs vis-a-vis your variable costs. So different industries have different operating leverage characteristics. Different companies within industries have different operating leverage. Cyclicality. If you're at risk of being a cyclical industry, you're probably not going to invest in fixed costs because you'll have a lot of downtime. You'd rather keep your costs variable so that when things are bad, you're not spending a lot of money. So if you're an industry where cyclicality is important, you wouldn't want to invest. But look at an industry like the utilities industry. It's less cyclical. Yeah, they have seasonal cyclicality, but economic cyclicality is not really that strong. So they have very high fixed costs versus variable costs. Where you are in your product life cycle, the chart we looked at in Chapter 3, affects your return on assets. Early on in a product life cycle, you're going to have lots of capital expenditures and not get a whole lot of results for that. Later on, as you go through the growth phase and the maturity phase, you start to pay off. So you need to look at where you are as an industry. Or if you're a product with a very quick life cycle, you need to continually invest capital to improve that life cycle, to improve its profitability. So it requires more capital expenditure. So there are two kinds of constraints on companies. Capacity constraints and competitive constraints. Capacity constraints. These are companies that have large fixed capacities. And it takes a long time to add capacity in that industry. Utilities would be an example of capacity constrained industry. It creates natural barriers to entry. It's hard to get into the industry. But what it does do, it results in an upper limit on your asset turnover. You have lots of assets, and your asset turnover is stable from year to year. So if you want to increase your ROA, you have to increase through profit margin in these kinds of business. So if you're constrained by capacity, the way to improve your return on assets, because your assets are constrained, think about your numerator and your denominator. Your denominator doesn't change. The way that you'll change your return on assets is the profit margin. On the other hand, if you're, and this is generally true for competitive constraints. I'm sorry. This is cost leaders. I misspoke. Competitive constraints. You have commodity-like products. There are low barriers to entry and intense competition. So you're competing. So these cost-constrained companies, low-cost providers, they're not going to make a lot of money through increasing profit margin. Their profit margins are going to be thin. Think of grocery stores. So they make it up on volume, essentially. You make it up on volume. So you need to focus on cost management, keep your costs down. You're going to generally receive very low profit margins, and you need to turn over your assets turn over inventory, for instance, in a grocery store in order to improve your return on assets. So depending upon the type of company you are, you'll either be able to improve your profit margin or improve your asset turnover. Product differentiators focus on profit margin. Cost leaders focus on asset turnover, volume. So this is an interesting chart. Probably looks confusing. This band here, between these two bands, is what the typical return on assets is. Return on assets are between 3% and 6%. Return on assets 3% to 6%. And it's a function of profit margin and asset turnover. Profit margin times asset turnover is your results. So on the one end of the spectrum, utilities. High profit margin, low asset turnover. They have so many assets, lots of fixed assets. Their ROA would be, let's say, 9% times 5%, 4.5%, 9 times 4.5. No, I don't know how to multiply that. 10 times 4.5 would be 0.045. So maybe it's 0.04 or 4% ROA. On the other end of the spectrum, grocery stores. Grocery stores have a lot of asset turnover, 2.8 turning over of assets. Low profit margin, 1.5%. So there, 2.8 times 1.5, once again, up out of 4% ROA. So this band is the band of ROAs. Pepsi's ROA is 15%. In an industry, consumer products, that averages 5%. There's a perception of value beyond the industry right there. Can you find your industries? So your industry groups in here, or something similar to them? Try to see where your industry group would fit. It's from version 6 of the text, which is 3 years old, 4 years old. So reasonably recent. They don't change dramatically. You guys are UPS and FedEx? Do you see anything? Transportation, not equipment. It wouldn't be so much equipment, though. I mean, they do have equipment. They do have the fixed costs of the equipment. But it's more of a service.
That's like the most.
Look at that poor airlines industry. It's just a shame. See, I don't see yours so much in here, and you all are. Your airline? Oh yeah. But Southwest actually makes money. They're the only ones. And we are food products. Right in the middle. Right in the middle. Okay, and team 4. What's it? Pharma? It doesn't really have it here, does it? Health services, I think, would be the closest match. I think it would be the closest match. 5. Chemicals. Except it's more value added than just petroleum. Petroleum is a true commodity, whereas you all are adding value through patents and things like that. So it's a little bit different. So you'd expect it to be a little bit elevated versus petroleum. And then we have retailing and apparel. you know, outside the band on the top side. So anyway, kind of an interesting view of the world.